Hello and welcome to another Smaulgld live stream. It is Sunday evening, December 9th, 2018, and welcome Smaulgld Game Changers. Tonight, we're going to be talking about American Gold Eagle sales, and they have fallen to their lowest levels since the pre-financial crisis, and that was in 2007. We've got a lot of charts, and we're going to take a look at those, and also I've got a trivia question for you about gold. So let's take a look first at what gold and silver are doing. In the aftermarkets, they have opened up, getting ready for tomorrow, and they're about as flat as can be. Gold at 1248.50 and silver at 1457. So not much going on there. Well, let's take a look now at the American gold. Oh, we have to take a look at the crypto prices, and then we've got to do our introduction. We have to stick to the format here. Bitcoin, $3,573, up 5.20%. Ethereum at $94, at 4.5% higher. Bitcoin Cash at $108, up 8.6%. And Litecoin at $25.51, up 5.7%. All right, well, let's now take a look at American Gold Eagle sales and compare them to gold sales in general, gold demand in general in the world, and also compared to last year. And then we're going to compare them to silver and the gold-silver ratio and so on. Uh-oh, we got a moron here.
Presenting the distinguished international news commentator and foreign correspondent,
Smaulgld. This has been an extraordinary week in world affairs.
No, I told Hillary Clinton that that's moronic.
Okay, well, I have received word that the U.S. Mint is now closed down for the year. They announced on December 7th, according to Coin World, that they are now preparing the 2019 coins, both the American Gold Eagle, the American Silver Eagle. So the Mint is now finished making the 2018 coins, which means that in December they didn't sell any American Gold Eagles, and that was it. So that was the worst December sales of American Gold Eagles since 2015, when they sold no American Gold Eagles. Generally, December is not a bad month, as you can see. The first year they sold 334,000 in the month of December. Well, that was because they only opened up in September for 1986. That was the first year of the Gold Eagle and Silver Eagle coins, and they were a big hit. And you can see there have been other Decembers that have been pretty good, but this year they decided to throw in the towel early, and this year was, and we're going to take a look at the current sales for the year. They're going to end up at 1 ounce American Gold Eagles at just 188,000. Now you got to go back to 2007, as you see on your chart, when the U.S. Mint only sold 147.5. Now some people might draw the conclusion or draw the analogy or make a connection and say, 2007, not much in the way of gold sales, and then the financial crisis hit in 2008, and boom. Some might say that the low gold number sales means it's a predictor of financial crisis and higher gold sales, just like some people say that when you have an inverted yield curve, that somehow a recession is going to happen within the next 6 to 24 months. Well, there's always a recession around the corner, whether the yield curve inverts or not. And there's always probably an increase in gold sales around the corner, and probably even a financial collapse around the corner. But we can look at this and say that 2007 was a very low year of sales for American Gold Eagles, as was 2018. You draw your own conclusions. See some other charts on American Gold Eagles and see how we've done during the year. So here is 2017 versus 2018. Actually, 2017 was a very bad year as well. The only thing that saved 2017 from a really worse year than 2018 turned out to be is they sold a lot in January. You can see that 86,500. But for most of the year, you can see in the red, 2018, the U.S. Mint outsold 2017 most of the year. Other than the first couple of months, first 3 months, since then, the U.S. Mint the 2018 outsold 2017 in May, June, July, August, September, October, and November. But in December, they're not going to do anything near outselling them because they're not going to sell any in December. The Mint is now shut down for 2018. And they're starting to make those 2019 American Gold and Silver Eagles. They're available for pre-order, I believe, on all the Smaulgld affiliate links. So if you want to get the 2019s, you can order them now, I believe. But some people like to pick up the 2018s and make sure that if they're collecting them, that they have one from the current year. Speaking of which, what does that do for premiums on the current coins? Well, they go up, as you can see. They go up a little bit. They always go up the last, you can see at the end of the year, they go higher. Look at the end of 2016, end of 2017. And they haven't really gone up yet in 2018, and maybe they won't. But that's just a function of dealers realizing that they're not going to get any more fresh coins from the mint or fresh coins from the authorized purchasers, and they're going to have to, they're counting on now ordering the 2019 and promoting those coins, and then any 2018s after that they may have to sell may come from the aftermarket that they buy in the secondary market. So they're running out of their inventory 2018. They've probably got big pre-orders for 2019. So they tend to bump up the premiums in that final month. And since they've stopped making them, and this year they only made 188,000 of them, not quite a collector's item, but not a key year either. But there's not a lot to go around if people make a rush to buy at the end of the year just to make sure they get a fresh mint packaged 2018 gold coin. And I think we showed you December, right? There's December. Yeah, we did show you that chart already, so we're not going to show you that one again. And now let's take a look at the price of gold, because we usually look at the day's price of gold, and then we look at the day's gold-silver ratio. I want to take a look at a longer-term chart of gold and also silver. So here is the 1-year price of gold, and you can see we started out basically where we started almost. Then we had a very nice January, March, April, May. It looked like it was going to be a big year at 1340, 1350, and then we had that inexorable decline, that steady decline from May all the way through to September, and then it really wasn't until early October that we started to bounce off that bottom. And it looks like if we get follow through on this rally that we've had since the beginning of the month, you can see that to the far right, that we might close flat, because right now we're down about 2.37%, just about $30, not that big of a deal. All right, let's take a longer look now at the gold price over 5 years. And this somewhat illustrates, a lot of people are disappointed with gold, but does illustrate somewhat a store of value. This is 2014 to 2018, and what do you expect? I mean, you're up $6, you're up 0.5% over 5 years. That's not bad when people in today's world consider the dollar, for whatever reason, as the premier fiat currency in a store of value. You're actually beating the dollar over a 5-year period in which we would consider gold not doing very well. But that's not bad. And if you put the money in gold for 5 years and you still have it when you come back, you haven't lost any money. Now, you might have lost a bit on the inflation, that's for sure. The year's not over yet, and of course, at certain points on this chart, you were up a bit more. I mean, we have hit in each of the in 3 of the 5 years spikes over $1,350. So there were times to get out. If you time your buys in gold, you can actually outpace the dollar. Silver's a different story. Let's take a look at silver over 5 years. It's not good, and that's why it's not why they call silver the devil's metal, but you can call silver the devil's metal because of the volatility. So you can see here, basically, the low was 1050 and the high was 1350. $300 difference. But for the most part, it ended up flat over 5 years. Look at silver. You lost 25%. And look at the volatility from $14 or $13 to $22 over that period of time. That is a massive difference in price. That would be considered gut-wrenching if you own stocks like that. Silver is not the reliable store of value that the silver pumpers tout it to be. It is, when it's low, it certainly has the ability to spike. Look at that. From 2016, you went from 13 to 21. That's pretty good. That is a big gain. That's nothing to sneeze at. I mean, people expect to the moon, but that's still a very good gain. That is a that's a 62% gain in what? 3 months, 4 months? So that could happen again in 2019. You can just as easily see it go to 21, or maybe it drifts lower, but it hasn't really drifted much lower than that in the past 5 years. So you could be building a base here. Now, let's take a look at the gold-silver ratio. Let's say you had bought gold versus silver or silver versus gold. How would you have worked out? Well, if what anyone was telling you at any point you had to buy gold, you had to buy silver because the gold-silver ratio was unsustainable. Silver is the most valuable thing in our lives. We could not leave our lives without silver. There will be a silver shortage, and then it will be game over, and the COMEX will default, and JP Morgan has 800 million ounces of silver, and they are shining the stacky. All nonsense. Look at that. You started 4 or 5 years ago at 60 to 1, and they're all telling you you have to buy gold silver ratio unsustainable. It will go to 16 to 1, the natural ratio. Hasn't been 16 to 1 except once in over 150 years, and that was in 1980. Then it will be 9 to 1, and then it will be 1 to 1, and you will not be able to find any silver. Well, right now we're 85.8 to 1, and essentially you lost 35% versus gold. That is a big gain in the gold-silver ratio. And it's not because gold went skyrocketing. It's because silver just didn't hold up. Wasn't a store of value over the last 5 years as we saw the gold was. I don't know why people don't see that. I think they listen to silver pumper channels who convince them silver is always the smoking buy. It's not. Generally, it's not. When is silver the smoking buy? In every couple of 20, 30 years when it spikes like crazy. Other than that, if you're holding over a period of time, gold is much more stable. Now, if you're trading silver, if you go back and if you're just a trader in and out, which you really can't do if you're stacking, you don't have you can't be that nimble. But if you were trading silver, you'd rather trade silver than gold. Why? Look at that. You're up and you're down, you're up and you're down. You're making money. Look in 2017, you've got from, it was almost 1850 in the early to middle part of the year. Then it dropped. You could short it down to 15 and a quarter, and then ride it right back up to 18, and then right back down to 15. You could see how it's a trader's delight here, but it's not a buy and hold, and for the long term, the way gold is. Now, if your long term is you're stacking up, and every time it falls, you're waiting for that 30-year spike. Well, then sure, you're going to do well, but there's so many myths around silver about the gold-silver ratio. Silver has been demonetized, and part of the gold-silver ratio, even during the last 100 years, was skewed downward because the price of gold was fixed at $35. It would have been much higher. Ever since they got rid of the gold standard, the dollar standard under Bretton Woods, and gold was allowed to float, silver's been averaging 55, 60 for the last 50 years. And there's not like it's going to return to its natural ratio when men wore togas and rode in chariots. If you believe that, that makes no sense at all. We're not in Roman days. You're going to work for an ounce of silver. No one thinks like that anymore other than people who watch YouTube channels. Okay, what else do we got for charts? It's all gold and silver today. So we've done the premiums. Oh, people like this one. Dow versus the gold. Now this chart shows. If you do, I have one. It'd be embarrassing to show silver versus the Dow Jones. It just underperforms the whole time. But gold holds its own. And right now, the Dow is 19.9 to 1 to gold. Now, in a real gold bull market, you get down in the single digits. You can see in 2016, the Dow gold ratio was only about 12.5. That was pretty good. Some people say when you get under 15 is when you sell. Some people say when it's 1-to-1 you sell. Who knows? If it ever goes to 1-to-1, well, that would mean that gold would be $25,000, right? Because the Dow is 25,000 or it's 2488 or something like that. I think most people would be out long before then if you had a 23, 24 fold gain, but you never know. Depends why it's rising, why it's going there. Or it could be a function that the Dow craters and then gold holds up, and that's where they would intersect along that chart. All right, one other thing, silver to gold, silver eagles. This is not really that instructive, but it's fun to look at. The U.S. Mint, as you can see, before 2008, used to sell tremendous amounts more relative to silver on a dollar basis and even almost on a unit basis. In 1986, they didn't even sell 4 times the amount of American silver eagles to American gold eagles. And even in the height of the financial crisis in 2009, they only sold 20 more American silver eagles to each gold eagles. Gold was the big deal in 2009. It wasn't silver. Silver picked up in 2011-12. Actually picked up after the price dropped after 2011. That's when silver became the go-to metal because it was cheap. But really, let's go back to the gold history, and you'll see what happens to gold. 2007, as we mentioned, no one's interested in gold. Most people aren't thinking about financial crisis. 2008, that's 794,000 right there. Under 2008, that was when the financial crisis hit in October 2008. But look what happened in December in 2008. $176 of that was in December. That's when there was full panic mode in December. He hadn't even announced QE1 yet. Big sales in December 2008, which was a good portion of the sales. They were selling at the same pace in 2008 as the poor pace they were selling in 2007. It was the last 3 months that booted that number up to 794. But look at 2009 when the financial crisis was in full swing. 1.3 million. They hit a nearly an all-time high. The all-time highs were during the Y2K. And then as you can see, as the crisis subsides, 2010 was still a crisis year, 1.1 million. And then it goes down. Then it goes back up to 817 during the Brexit. And then the last couple of years, people are like, oh, Trump's in office and everything's fine and the stock market's going higher. And then we know what happened after that. We don't know what happened after that. We know what might happen after that. But let's look at the silver eagles in comparison. 2008, it didn't. Yeah, they went up, but it wasn't until you can see 2013, 14, and 15 that silver, or really 2012, where you really got high. 2008 and 9 were not the biggest years. You can see that. They were big in gold. Silver took off from 10 to 15, whereas gold started to decline after 2010. So you could see silver pumped up, and now silver's dropped dramatically because the fact that silver's cheap is no longer a novelty. Silver's been cheap since 2015. So the idea that, oh, every time it goes to $16, it's a buying opportunity. Every time it's under $20, it's a buying opportunity. Oh, it's at $15, I got to buy some. I think there's buyer exhaustion in this back end of the chart here, where you see 18 million, 15 million. And again, you could go back to 2007 and say that was the last time we had sales this low. What happened? Financial crisis. I'm not predicting one, but if there were to be one, obviously, I think, and there's a good question for you in the comments, will gold and silver react again the way they did in 2007, 2008, if there were indeed to be a financial crisis. All right, let's see. I got a couple of more charts. Let's see what we got here. All right, let's see. Got that. Premiums. I got a poll for you. A silver poll. And the poll asked people on Twitter, at the end of 2019, where do you think the price of silver will be? Well, I should have asked you guys this, but I didn't. And you can see a quarter of the people think it'll be lower than it is today. 36% think they're going to be a robust gain between 16 and 20. Some people think it'll go 20 to 25. And then hope springs eternal amongst 32% of silver bugs, and they think that we'll see over $25. Okay. I don't know what I think I voted 16 to 20. All right, let's see. Now for the trivia question, then we'll get to your comments. I'm going to hold off on that and see what you guys... Okay. So everybody knows, and I'm going to ask you in the comments, who are the number 1 and number 2 gold consuming nations? I'll let you put in your comments, see what you get. Who's number 1 and 2? They alternate, they're very close. But who would be the number 1 and number 2 gold consuming nations? No one want to guess? I mean, you should know if you've been watching this channel. Who are the number 1 and number 2? There you go. China and India, says Maddie D. And they're very close. Some years it's China. Some years it's India. Delaville, she's got it as well. Yes, India and China, India and China. You all got it. Okay. But now, here's the trivia question. Which country is the 3rd largest consumer of gold? Anyone want to guess? Third largest consumer of gold. It's all forms. That would be bullion, medallions, jewelry. Russia, we're saying Russia, okay? Russia, everyone's saying Russia. It's funny because I have Russia as part of my answer. Turkey's a very big gold nation. Yes, this is not per capita. This is per in total tonnage. Maddie D, ding, 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 winner. Yes, Maddie is correct. The United States is indeed the 3rd largest consumer of gold, and that's largely on the basis of jewelry. Take a look at that chart. Now, it doesn't come anywhere near the prodigious amounts that China produce. I just looked at this quickly from the GMSS Gold survey through the 3rd quarter. This is 2 years worth of data, so it's pretty consistent. And you can see China and India neck and neck is gold consumption. But here's the interesting point. When you guys were saying China, Russia is supposedly buying gold hand over fist, right? Like, that's the biggest story. I think every other time I produce the monthly numbers, Zero Hedge runs it and talks about dollar collapse and Russia's buying, they're de-dollarizing. Well, Russia buys about 200, doesn't buy, they mine about 300 tons of gold every year domestically, and they put about 200 and 230, 240 tons of that gold right into their central bank because their own currency is horrible, and it makes sense. Gold is as good as gold. It's better than the dollar, so why not, if you have gold, put it into your central bank? Kazakhstan, we see, does the same. But here's the interesting thing. I always try to make the point that Russia's overall gold hoard, which is over 2,000 tons, is only worth $79 billion, which again is less than a month's worth of QE. It's less than a month's worth of the Fed's QE. It's less than a month's worth of the ECB's QE, the European Union's QE. It's not a lot of dollars. I mean, it's a lot of gold, but it's not a lot of dollars. But my point is that in 2 years, you don't even think of the United States as a big gold consumer, but the United States, just the jewelry market alone, accounts for 160 tons a year. And you don't think of Americans stacking like crazy because they know what's coming and all that kind of talk. The idea is gold is it's jewelry, it's trinkets. I know gold is money, period. And JP Morgan says that gold is money and everything else is credit, period. No, gold is jewelry. The main use for gold is jewelry. These big numbers here that you're looking at, India, China, those aren't stackers. Yes, they may buy investment grade jewelry and they do view it as a store of wealth, but they're not stacking coins in bars. I think that's the same with silver. The silver stacking is even less. We saw, if you guys haven't seen it, go back or search for Chinese silver stackers versus American silver stackers. You'll see that Americans actually buy more investment silver than Chinese do on a gross basis, not on a per capita basis. The United States consumer buys, because of all these gold silver channels, all of these silver pumper channels, they actually stack silver more than Chinese do. Now, China has greater silver demand than the U.S., but not for bars, rounds, and coins. Chinese do not stack silver. And they don't even really stack gold. The concept of stacking is not akin to their nature. If you talk to people in India, they buy silverware. They buy silver jewelry. I think for 1 year, I think it was 2015, there was some enhanced bar demand, but for the most part, they're not stackers. That's something very important. I think that's one of the things that they sell you on, is that the collapse is coming, get prepared, stack on. I don't know. That's not the bulk of demand, nor is central bank demand either. It's jewelry. And there's nothing wrong with that. Jewelry is a sign of wealth, not collapse. People keep talking about collapse, collapse, collapse. Silver and gold are signs of wealth. The golden era, a silver moment. It is, actually means you don't know what's going on. Well, maybe that's the case. Have a silver moment, a senior moment. But you're going to sell more gold when countries and people are doing well, rather than when there's a crisis and a collapse. That's a fact. All right, let's see what people are saying. Oh, we got Bell and GP. Yes, gold is status. That's right. Indians and Chinese, the reason there's such a big demand now the last 10 years, it's an easy answer, is their economies have increased dramatically. The numbers of people in China and India that are now in the middle class in each country are larger than the entire population of the United States. So they have money. They want to buy stuff. They're not all in bunkers and stacking. They're buying jewelry. They're buying silverware is amazing because no one has silverware in the United States. No one has silverware probably anywhere. India accounts for 70% of silverware. And I think if silverware was, I wish they don't even make it anymore. I was trying to find silverware online. All you can find is like old pieces, and I would buy a silver set, if the prices go to $10 an ounce or something. It's a beautiful thing to have. When I was a kid growing up, my parents had their wedding gift sold in 1980 during the Hunt Brothers. But they had it, and I used to have to shine it before Thanksgiving. It's a great thing, but really culturally, that's gone the way of the dodo bird in the United States, but not in India. Indians feel if they've got some extra rupee, they'll buy a silverware set. But I'm going to stack bars and coins and rounds. That's an American thing. All right, let's see what we got in the questions. The comments and all of our Smaulgld game changes. Well, Roger is here. Roger from Ausland. Let's go, Lewis. You're late. Yes, I was. 30 seconds. De La Villa's here. A lot of regulars here. You'll notice the game changers are all here. Most of them got their Smaulgld mugs in front of them. For those of you who don't know what we're talking about, the Smaulgld mugs are really the glue that keeps the crowd together here, because pretty much everyone who's here every night is going to be sporting their Smaulgld mug, one or the other, either a travel mug, classic mug, super classic mug, or a espresso mug, or some of them come and they have their adult beverages in the Smaulgld beer steins, either the frosted or the My favorite is the 22-ounce. Well, let's first show you the frosted mug. There's your frosted mug. That's a 16-ouncer. Put that in the fridge. It frosts up even more. Not the fridge, the freezer. It frosts up even more. All available on Smaulgld.com, or you can go over to Zazzle.com/Smaulgld, and you can check these mugs out. But this is my favorite. This is the Smaulgld. It's like a tankard. There you go. That's $24.99 from the store. Go to Smaulgld.com. Pick yourself up one and join the Smaulgld mug game changers. All right. Lowest TRP says lowest sales since 2008 sounds like a buy trigger to me. Well, that could be. Again, you do see historically people forget what they get complacent. They don't care about the gold or the silver, and then all of a sudden they get so complacent they stop buying altogether. Or maybe in the case of silver, they get so discouraged they stop buying it, and then boom, you have a crisis, and then the people rush back. My question really is, and I guess I should put this up as a poll, will people rush back? I don't know if we're in a new era or not. People always claim we're in a new era. It definitely worked in 2008, 2009, 10. All right. Mate says they could still be selling stock already made. That's right. That's exactly what happened. What happened is the mint has basically shipped to the authorized purchasers their allocation for 2018, and the authorized purchasers made their purchases on the basis of what they might need to the end of the year for them to on-sell to coin shops and online bullion dealers. And so they're done. But in some years, if the demand is still going strong, they still have to make coins in December because there's demand. Right now, what the authorized purchasers probably relayed back to the U.S. Mint was, no, we're good. Go ahead and make your 2019s, and we'll start ordering those. All right, let's see. Prashanti Girl is here. Pablo Pena is here. Mug holders all. All right. Pablo, we missed you last night. You weren't here. Max is here again. Yep. Matteo De Fiori. Hey, from New York. He's from Queens. Forget about it. Matteo, what part of Queens you from? Gotta find out. Look you up when I'm down there. All right. Paul Campbell. Bitcoin suck. Well, there's an intelligent comment. TRP. I have a silver stacking problem out of 4mm airtight. Oh, okay. You got to get the... Well, they say you're supposed to put the coins in airtight because silver does tarnish. And I like to hear from people who've tried to sell coins that they haven't properly kept, whether that impacts your resale if you bring in a coin and it's kind of tarnished or a little scuffed. All right. Pablo Pena says, imagine all the mugs and silver you can get for 1 Bitcoin. Yeah. I mean, I take Bitcoin too. I take Litecoin, Ethereum. If you guys, we have to talk about Patreon, but not right now. Let me get through these comments here. Bitcoin is locked and loaded. Could be. Could be. You know what's happening, Matteo, is my view is that 2017 was a big spike. It was unbelievable what happened in the cryptocurrencies. And Wall Street's looking at that and going, we don't get any of this. How did this happen? They had $4 billion worth of totally bogus ICOs. None of them are registered. Nearly all of them should have been registered. And monkeys with white papers promoting them on YouTube by monkeys. You know, people had no knowledge of anything. Just like, oh, ICO and Joe token and Bear coin and all kinds of stuff. And then they had celebrities promoting it, and then there was BitConnect and all that kind of stuff. And Wall Street's looking at billions, tens of billions of dollars flowing in and out of this system, and they're getting nothing of it. Well, right now, you've got Bakkt coming online in January. What is Bakkt? It's Microsoft and the New York Stock Exchange are getting into a trading platform, and Microsoft, Boston Consulting, and Starbucks are involved in that. Fidelity Investments is opening up a trading platform. TD Ameritrade is opening up a crypto trading platform. Goldman Sachs has investments in Poloniex and Circle and stable coins. They're getting that ready. there's at least 8 different investment companies, including Van Eck, that are looking to get a Bitcoin ETF going. If everything goes their way, they will have their bubble, whether it's in 2019 or 2020, because the thing is, they know how to run a bubble. That's the whole, that's what they do. They can get a company like Tesla to be worth $35 billion when, again, not investment advice, but it's not worth 2 cents if the company is considered almost a going concern and it doesn't make any money. So you can see what Wall Street can do when they financialize a particular product. So yes, Matteo, it could be a big year for cryptos next year, or could be, as TRP says, locked and loaded for coffin. Who knows? That's the thing about crypto. They can go either way. They go to 0 or they go to 20,000 Bitcoin, because we've already seen it go to 20,000. My guess is if Wall Street's involved in this, yeah, they might bring it down more, but I'm sure they can promise investors that they can get that sucker right back up to 20,000 if they want to. Okay, De La Ville, Deutsche Bank inverted yield curve, the theme for buying gold and silver from the silver gurus. Well, first of all, the inverted yield curve, it's overrated, because as I mentioned, there's always a recession coming up. That is one of those correlation things that isn't proved to be causative. And we went through, you can go back and check out, I think I did a pretty nice explanatory video on the inverted yield curve called Get to the Bunkers, Inverted Yield Curve. I don't know that it means a disaster just because the yield curve is inverted. The yields already in this cycle are so compressed as it is that it's not hard to get them to invert. Now, Deutsche Bank is a different deal, but again, the reason Deutsche Bank might not be a big deal, we saw news today, De La Ville, that the German government may take a stake in it. Well, once the German government takes a stake in it, it's like in Goodfellas. They're partners. You know, if anything goes wrong, blank you, pay me. I mean, it'll work out. They won't collapse. It'll be a zombie bank. But again, it won't have the knock-on effect and the derivatives and all the game-changing collapse stories that you hear there. Yes, if Deutsche Bank implodes, creating a derivative crisis, and what do you think will happen to metals? That's people using big words. I think a lot of people don't even understand what derivatives are. They don't understand that the notional amount is pretty much irrelevant. It's the net exposure. I'm not going to get into it, but I spent a lot of time preparing the forms, the swaps, derivative documents, the notional amount. They just, it's quadrillions of dollars. Yeah, but I don't know if you guys have the patience for this right now, but generally, if you have two parties in a contract, generally, they're not there to create risk. In many instances, they're there to hedge risk. So let's say I owe money in dollars because I have a mortgage, and every month I got to come up with $680 for my mortgage. There's a Japanese gentleman who's got to come who has a who also has a dollar obligation, and you swap out the obligation, and it's not even worth going through. The point is that it ends up being a net nothing in most cases. So that's why when they say these derivatives, one person has a bet on one side, the other person has a bet on the other. One side wins, the other side loses. Well, that's a wash. There's not a collapse because of that. Now, that's not quite that clean, because if one side loses and one side has thousands of swaps, you would also think that, well, if they have 10,000 swaps or 10,000 derivative contracts, they may win on 5,000 and lose on 5, and they even still would be even. The issue becomes when one side has 10,000 swaps and somehow they lose on the majority of their swaps, and that creates their inability to pay out on the other derivatives that they owe to somebody else, which means the somebody else was counting on that money, they don't get it, and then they have a problem, and then they can't pay. You can see how the whole thing goes into the daisy chain. So that is an issue with derivatives, but it's not necessarily likely that that would happen, because it would have to be asymmetric. Would have to happen. There'd have to be so many more on one side of the credit default swap than the other side, and it is a risk. But derivatives are also anti-risk. So that isn't, to me, the biggest risk in the market. People keep saying, like Warren Buffett, derivatives are weapons of mass financial destruction. Well, they're also weapons. They're also insurance. It's almost as the bigger the derivative get, then you create more derivatives to hedge that risk and back and forth. All right. I didn't quite explain it properly, but one day I'll do a whole thing on derivatives based on the work that I've done with them. Okay. David Morgan, let Zhang all say silver to 600. Well, there you go. That's what's going to happen. And that's all that matters, period. That is all you need to know. I saw someone on the YouTube, and she was waving papers in front of the screen, and she was saying, look at this chart. It means that silver is going to $600, and she is smart. And so I am buying silver. And Cliff High, Bitcoin to 100,000 by December 2. Of course, got to. Max Strong. The gold, silver, and crypto community are the same common interest, so we try to learn from each other, yes, but healthy criticism and good faith is always welcome. Yeah, that's true, but the one thing the gold, silver, and crypto community all have in common is they like to pump. They really, really like to pump. And then some of them hate each other. There's gold and silver people. All cryptos are going to zero. They are digital illusions of wealth. And then there's people in crypto that just think that the metals are... they are of the past. They don't really think the gold. They actually act like Keynesians. They think it's the barbarous relic. All right. Same interest, not the same thing, though. That's right. Crypto makes silver look good. All right. Cliff High lives up to his name. Well, I have a character called Valley Low. Those of you who've been with me a few years, you might have heard some of my Valley Low predictions. He's got a thing called Wishbot. It's different than Webbot. Involved in more different... it looks at data from in more languages than Webbot. And you actually pay Valley Low money, and he'll grant your wish. He'll run it through the Wishbot and make sure that it works. All right, let's see. Silverbug TRP thinks we're going higher. No, going lower first. All right. Vatican City and Malta. Maybe per capita, they have more gold. Bell and GP. Trying to call a price for gold or silver 1 year out seems more like gamble to me than savings. Well, that is definitely true. Look at all these Russia. It looks like a Democrat convention here. Turkey. Turkey's a good guess. Turkey, for its size... actually, Turkey's not that small. Turkey's bigger than Italy in population. But Turkey is... if you ever go to Turkey, they're very interested in gold and silver. They are... they're probably, as a country... Yeah, they're ahead of South Korea. Iran is a very big jewelry buyer, too. Very different... you wouldn't expect it. United Kingdom is actually bigger than Italy for jewelry, gold jewelry, but Turkey's the biggest one in that region. They count that as part of Europe. All right, what other comments do we got here? Big comments. Third is Bulgaria. I don't think I have numbers on Bulgaria, but Bulgarians probably like their gold too. Matty says boom because he got the answer right. Matty wants his cookie. India. Yes, always. Russia mines a lot more than 300 tons of gold, but the employees steal a fair bit too. Don't know what you're talking about there. So are Indians stacking silverware? I guess. I don't think they think of it as stacking. I don't think they watch YouTubers talk about silver stacking, but amazing amount of silverware that they buy. 70% of the world's silverware. Pablo says there are market crashes and usually happens every 10 years. That is correct. Silver to the moon. Yes. All right. Mate, it's all rappers and their gold bling. Rappers to the moon. That is all you need to know. Well, that's true. The reason rappers have gold is to show that not only are they not poor and that they got it going on, but they're rich. They got gold. For Shanty Girl Lewis, do you think USA will get a stock market temp rally or more sustained rally like Brett Johnson's Millstrake Armstrong? I don't know. I don't know. I don't predict short-term stock markets at all. Let's see. We already got that comment there. Ask Cliff High. Yeah, exactly. Okay. I'm not going to repeat some of these here. His guess is as good as anyone. Fed killer says Germany. Prajante Brett has a grip on what's likely to happen. I killed the bank, agrees Shark. Sideways trend could go either way. Elon Musk will put a Tesla on Mars before gold hits 2000. Occupy Mars. Okay, TRP. Derivatives make no sense to me, so they make no sense in the markets. Why make a bet if it means nothing to your bottom line? No, it can. Okay, let me explain it again. There's many different types of derivative. A swap that I was trying to explain, that's not a derivative. That's where I have obligations in one currency and someone else has obligations in another currency, and we both have income coming from the currency that they want. So I have income coming in dollars, the other guy has income coming in yen, and I have to pay in yen and he has to pay in dollars. So rather than us go around and try to find the money, we just swap each other's streams, and then we end up paying each other and it all works out. That's not really a derivative in the sense that will wash out. That unless one of the income streams dies, and then there's a credit default swap event, and then you unwind the deal. But that one isn't really, you're not going to make money or lose money off of that. That's a hedge. But then there are other derivatives where you bet on them. And that's where the danger is, where you bet on what's going to happen. And they're not regulated because they're not securities. You bet on what the stock market is going to do. You can bet on anything, and someone takes the other side, and they're all private transactions, and they're not listed anywhere. And then even companies don't necessarily have all the derivative accounting buttoned down properly. So you really don't know the total exposure on the derivatives. Now, on the ones that are basically credit swaps, where you back and forth, currency exchange agreements, things like that, those are easy to stack if you're putting the financials together for a company, and you could see what your exposure is. You can see how many foreign currency exchange swaps you have. You could see whether you're in the money, out of the money, and you can manage those. And those aren't really going to be a problem. It's when companies are trying to make, as you say, sense. They're trying to make money, not hedge. Then there's an issue. But even with the people trying to make money, there's always somebody taking the other side of the bet. So it's the total net exposure, and it's very hard to figure out. But in an ideal world, that imbalance shouldn't be magnitudes one way or the other. The problem is, even if it's not that it has to be magnitudes one way or the other, is if one particular counterparty that's big gets caught up in a swap issue, or just as we saw at Barings like 10 years ago, the guy made a stupid trade and then he was out, and then the next thing you know, that bank goes under, and there's other banks that are owed money from that bank. Then you have the daisy chain effect. So that's the same thing with derivatives. But there's other risks in the market too. And again, a derivative could be used to take the other side of what might be deemed to be risky, and then it should all work out. It's not that it won't work out in the aggregate. It's just that if a couple of counterparties like Deutsche Bank get hit and they're on the wrong side of too many trades and they go down, theoretically they may have swaps in the money elsewhere, but they may be overwhelmed with the ones that are out of the money, and that would mean that they wouldn't be able to pay out to the other counterparties that they owe money to, and then if they don't get their money, then they're going to default on their swaps or their derivatives that they can't pay out on, and that's when you have a crisis. So they are a big issue, and I'm not walking back that they are weapons of financial destruction, but they're also overrated as such, because any trigger, doesn't have to be a derivative, any default, any bankruptcy could cause the same thing. It doesn't have to be derivatives based. People like to use the word derivatives because it sounds smart, but you can have a major company, a major bank, have a major problem in paying, and it may not be derivatives based. And that could then have it could also be derivative based. Even if the company itself doesn't have a derivatives book, there may be companies and derivatives off of how well that company is going to do. But then they would be in the money if that company went under. But then it depends on who was on the other side, how much they lost. And if they lost a lot of money, they would go down with the company that they were saying wasn't going to go down. So it can get very tricky. All right. Derivatives, betting on two flies walking up the ball. Which fly will off first? Okay. Well, I want to thank everybody for joining me tonight, and we will see you tomorrow night. Tomorrow night will be Monday, and we'll get our first sense again of what's happening in the equity markets and the gold and silver markets, which right now are still exactly where they were when we opened up about 50 minutes ago. Gold at $12.47 and silver at $14.56. Thank you very much.